The tax break that's made investment property viable for millions of Australians, the one that's cut capital gains bills in half for the past 25 years, is being scrapped. If you buy an established investment property after last month's budget, those rules don't apply to you from July 2027. And here's the part that should make you nervous: the government's own replacement rules aren't fully written yet. Stay until the 8-minute mark. I'll give you a 3-step portfolio audit so you know exactly where you stand. Australia has had a 50% capital gains tax, or CGT, discount since 1999. Hold any investment asset for more than 12 months and you only pay tax on half the gain. That single rule made negative gearing viable. Negative gearing is when the costs of your investment property, interest, repairs, depreciation, exceed the rent coming in. The net loss reduces your wage tax today, and when you eventually sell, the gain is taxed at half price. The 2026 budget is rewriting both rules at once. From July 2027, for new purchases of established residential property, rental losses are quarantined. They cannot reduce your wage tax. The CGT discount is replaced by an inflation-indexed model with a 30% minimum tax floor on gains. CPA Australia, but the peak professional body for accountants, is publicly calling the legislation rushed and incomplete. 9 critical rules haven't been written yet. Stay with me. The grandfathering has 3 separate cut-off dates, and which one applies to you could be the difference between keeping your current tax treatment for the life of the asset or losing it in 12 months. Before you go anywhere, you need to understand the 3 dates, because they determine whether any of this touches you. Date 1, Budget Night, 7:30 p.m. on the 12th of May this year. If you already hold investment property or assets you bought before that moment, you are grandfathered. Your existing negative gearing continues for the life of the asset. Capital gains accrued up to the 30th of June 2027 still attract the 50% discount. Only gains accumulated after that point fall under the new model. Date 2, the 30th of June 2027. If you buy an established residential property between budget night and this date, there's a brief window. You can still negatively gear until June 2027. After that, losses are quarantined. Date 3, the 1st of July 2027. Established residential property bought after this date, no negative gearing against wages. Full stop. Now, the government has built in a deliberate carve-out. If you invest in a new build that genuinely adds to housing supply, you can still negatively gear against wage income. When you sell, you choose between the old 50% CGT discount and the new indexed model, whichever works better for you. The stated goal is to tilt investment away from existing housing, where investors compete with first home buyers, and toward new construction. But here's what CPA Australia is flagging right now: the definition of new residential dwelling, the thing that determines whether you access the carve-out, is one of 9 definitions that hasn't been written yet. You could be making a multi-$100,000 decision based on rules that still don't exist. Let me walk through 3 things the headlines aren't explaining clearly. First, we'd see what the CGT change actually means in dollar terms. Under the current system, if you make a $200,000 capital gain on an investment property held for more than 12 months, you're taxed on $100,000, half of it. At the 37% marginal rate, that's $37,000 in tax. Under the new model, the gain is adjusted for inflation first, which is genuinely designed to help long-term holders by stripping out phantom gains caused by rising prices. But there's a flaw. The ATO, the Australian Taxation Office, takes at least 30% of the full nominal gain, regardless. On that same $200,000 gain, the minimum tax is $60,000. That's $23,000 more. Whether the new system is better or worse for you personally depends on how long you've held the asset and what inflation has done over that period. For someone holding a property since the 90s in a high inflation environment, indexation might actually help. For someone selling in 3 to 5 years in a low inflation period, the 30% floor is going to hurt. One practical implication that's being underestimated: you'll need a formal valuation of your investment property as at the 30th of June 2027 to split the gains correctly. The pre-2027 portion gets the old treatment. The post-2027 portion gets the new one. If you don't have that record when you sell, the ATO will have questions. Second, what Quarantined actually means for your cash flow. If you're currently negatively gearing a property at a $10,000 net annual loss and you're on the 32.5% marginal rate, that's $3,250 back from the ATO every year. That's the subsidy the quarantine removes for new purchases of established property from July 2027. If you're still with me, here's the part that changes how you should approach any property purchase in the next 12 months. Your losses don't disappear. They carry forward against future rental income and capital gains when you eventually sell. But the immediate cash flow top up from wage tax savings is gone. If the investment only stacks up because of that monthly tax benefit, the numbers need rebuilding from scratch. If the property only works because of tax losses against wages, that's not really a property investment. That's a tax arrangement with a property attached. Third, the missing rules problem and why it matters right now. CPA Australia, in a formal media release on the 12th of June, called this bill rushed and incomplete and said it relies on 9 separate ministerial instruments to define who is taxed, at what rate, on which assets, and under what conditions. Parliament itself cannot tell you whether a recently completed apartment, a house and land package, or a converted terrace qualifies as a new residential dwelling. The Treasurer sets that definition by legislative instrument after the bill passes. The Senate can only disallow it after the fact. The Greens and Liberals have flagged possible delays. Business groups are pushing Parliament to reject the CGT changes entirely. The Senate inquiry is running right now. This law could still change materially before July 2027. If you're making property decisions today, especially around whether something qualifies as a new build, you're operating in a legal grey zone. That's not comfortable. But at least now you know it. Here's your 3-step portfolio audit. The payoff I promised at the start. Run this on every investment asset you hold or are considering. Step 1, classify each asset by purchase date. Before budget night, the 12th of May 2026, you're grandfathered, old rules for life. Between budget night and June 30, 2027, transitional. After July 2027, new rules in full. Step 2, classify each asset as new build or established. New builds bought after budget night keep negative gearing against wages and get CGT flexibility at sale. Established property bought after budget night loses the wage offset from July 2027. And until the ministerial instruments are released, new build means whatever your tax advisor believes it probably means, not what the law actually says yet. Step 3, stress test the cash flow without the wage offset. If you're looking at a new established property purchase right now, model it with zero ability to reduce your PAYG tax through rental losses from July 2027. If the property doesn't work without that subsidy, it doesn't work under the new rules. If it does work without it, you've found something genuinely worth considering. This is general information, not personal advice. For your specific situation, you need a tax advisor who's tracking this bill through the Senate and who can update you once those 9 instruments are finally released. Write down those 3 steps now. That's your audit. If this helped you get clear on what's actually changing, subscribe. New video every week on the rules that affect your money. The newsletter has a plain English version of today's 3-date audit. Link in the description. Got a question about your situation? Drop it in the comments. This is the fine print AU because someone has to read it.